Greetings all and welcome to Purple Trades. Today we are going to talk about a strategy. The name of the strategy is 1% per day strategy. Now if you're absolutely new to the stock markets or you're seeing our video for the first time, before heading towards this strategy, I would really encourage you to go and check out our full-fledged series on stock markets that we have recorded absolutely free. It covers everything from the scratch about equity markets, futures, options, technicals that would help you become a professional trader. If you've already seen that, great. Now we are going to talk about few strategies combining few technical logics and try to make money in intraday. Today we are going to talk about a strategy that gives approximately 1% a day on an average. So in today's video, I'm going to talk about these things. I'm going to talk about the concept, how it works, the risk reward ratio, what is the risk involved, what is the reward involved, and also I'm going to talk about accuracy with authentic backtest reports. So let's start. Let's talk about the concept. Well, if you're following our channel, you might have seen that in the technical analysis class, I've spoke about gaps, how gaps are getting filled. And I've also spoke about a scanner called as open high-low scanner. So today's concept is basically the mixture of these two things. Let me tell you what exactly is the concept all about. First, we only focus upon those stocks that have a good gap up or gap down. So stocks should have considerable amount of either gap up or gap down. Only then we take those stocks. That means only those stocks are in our radar. Next, the script will either have a breakaway gap or common gap. Now once the gap has formed, we really don't know whether the gap is going to be filled and it will be called as a common gap, or the gap won't be filled and the stock will keep continuing up, head up, and it will become a breakaway gap. We really don't know that. But the idea is to catch either the breakaway gap or common gap. So as said, the gap will either sustain or it will be filled. Doesn't matter, we'll catch the rally. To narrow down the scripts, we use open is equal to high or open is equal to low concept as well. Now, if I have to say that I am focusing upon stocks which are having gap up and gap down, there will be n number of stocks. To narrow down to only 4 to 5 stocks a day, I will also use another filter. As soon as the market opens at 9:15, the opening price should be equal to high price and opening price should be equal to low price. Now not many stocks have this criteria filled, so that narrows down our search as well. And the risk reward is automatically adjusted in the range of 1:1 to 1:2 depending upon how big the first candle is. I'll explain you about this also in a while. Historically, I've tested on last 6 months data. It is giving us an accuracy of more than 61% on selected Nifty 200 scripts. I've selected few good stocks in Nifty 200. I've ignored small stocks like Yes Bank or Idea, or small illiquid stocks, or big stocks like Bosch or Page Industries. I've ignored them. I've taken some good, decent 130 stocks which are liquid enough and trade well, and I've also included Nifty and Bank Nifty also. So how does the concept work? Let us talk about it step by step. Step 1, as said, find the stocks that are having gap up or gap down in such a way that open is above the previous day high or below the previous day low. Yes, so you have to we will not catch all the gap up and gap down stocks. We'll find such stocks that are having gap up or gap down such that they are above previous day's high or below previous day low. Let me explain you this. Assume that today the market has moved something like this. It has created a high and a lowest point. Next day when the market opens, I want stock to either go above this and open here and go up or down, doesn't matter, or open below the lowest point and go up or down, doesn't matter. So the idea is that today's open should be either above previous day's high or below previous day low. Let me give you an example. So I have an example of State Bank of India. So this is what I'm talking about. So you can see that yesterday the stock has moved something like this, and this was obviously its highest point, but the next day market opens somewhere here. So this opening is well above previous day's highest point. Similarly, this is again State Bank of India, where the stock has moved down, 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 creating this as the lowest point, and the opening is well above previous day's low. So the stock should either be above previous day's high or below previous day's low. Only then it qualifies. Now the next step, step 2, is to check if open equal to high or open equal to low in these scripts. Going back to the previous examples, you can see that in this particular script, the first candle does not have open equal to low or open equal to high. So this does not qualify. Similarly, this particular script also does not have open equal to low or open equal to high in the first candle. So it also does not qualify. So we want open equal to high or open equal to low. When open equal to high, we will only short. And when open equal to low, we will only long. For example, in the State Bank of India itself, on this particular day, you can see market went up, creating this as the highest point, but the opening was well above the highest point, and you can see that open equal to low, there is no lower candle. That means when the market opened up, that itself was the lowest point, and it just went up, never came down. So open equal to low also gives a further strong push to the market for the stock to go up. So technically this is a breakaway gap, because market has opened above previous day's close, and also there is open equal to low, indicating that right when the market opened, from that point onwards, bulls are pushing the market towards upside. Now where do you enter? You enter when the high of the first candle is broken. So let us say the high of the first candle is this. So this is broken in the third candle. So you buy somewhere here, and the target is 1%. 1% is a target. That is why the name of the strategy is 1%. So the target is 1%. The stop loss is either the low of the first candle or 1%, whichever is lower, right? So we are automatically managing the risk reward in the range of 1:1 to 1:2. If the first candle is very, very small, my risk will be very, very small. If the first candle is very big, then maximum I'll take a risk of 1%. I'll explain this to you more clearly as we go ahead. But right now, say we buy here and 1% is our target, and somewhere here 1% was achieved, and you are just out of the trade. Similarly, in same State Bank of India example, you have a gap up, a huge gap up, but you see first candle has open equal to high. There is no upper tail, so open equal to high. This makes it a good candidate to short. When the first candle low is broken, you short somewhere here, catch 1%, and you are out of the trade. That's it. Accuracy is quite decent. We'll talk about accuracy also, risk reward ratio as well. So this is the step 2, and step 3, as I've already mentioned in the step 2 itself, buy if the high breaks or short if the low breaks, right? So step 4 is if open equal to high, SL is first candle high. If open equal to low, SL is first candle low, or as also I said, you can predefine a certain percentage to limit your stop loss, so that risk reward is in your control. Now target is fixed, as said, it is 1% from the entry price. Now before I show this to you on the chart, let me tell you what are the uniqueness of this strategy. Well, firstly, there are only 1 to 5 trades a day. Even if I'm applying on Nifty 140 or Nifty 150 stocks, the selected 150 stocks, only 4 or 5 stocks at the maximum would qualify every day to trade in them. So there is only 1 to 5 trades a day, sometimes not even one, sometimes there are no trades in the entire day. Since risk and reward is known, we can also place bracket order for extra leverage. In the morning itself, I know what is my stop loss, 1% is my target. I can fix all of that and place bracket order also, or cover order with trailing stop loss as well for extra leverage. And also it's a powerful concept, and usually you're out of the trade in the first hour of the day. 90% of the time between 9:15 to 10:15 you're done with the trade, you're out of the trade, that's it. So if I have to go back to the previous examples, see this is 1 minute candle that I've taken. You get entry on the 5th candle, and by 15th or 20th candle, by 9:30 you're actually out, 1% done. Similarly 9:18 you enter, and by 9:30 or 9:40 you're done with the trade. So maximum 70 to 80% of the times you're just out in just 1 hour. Very rarely the stock will keep playing around in the flat market and it will trouble you for 2 or more hours, but usually 90% of the times I can say that you're out of the trades in just first hour. So this is again one uniqueness about the strategy. Let's go to backtesting and see how it works. I have created the algorithm and the visual representation also on AMI broker. Let me show you how it looks like. So alright, so this is my AMI broker. You will see that there is a red line and a green line. Green line represents yesterday's high and a red line represents yesterday's low. Easy for visuals. And first candle depends upon where the first candle is trading. Now the first candle of Ashok Leyland definitely does not have open equal to low or open equal to high, so there is no buy or sell generated. Whenever the conditions are met, you will see a green arrow for buy and a red arrow for short as well. Let me just show you. Say Voltas, first 5 minutes candle above the green line, so it qualifies. Open equal to low definitely because there is no lower tail, and you take a trade on second candle itself because the high was broken, and third candle you're done with 1%. In just 5 minutes the trade is over. Similarly on 14th September, that is today itself, I have another trade in MGL. So in MGL, first candle is again much above the green line, that is above the previous day's high, qualifies, and when the high was broken on the second candle you take a trade and it made you wait till 12 but gave you 1% target. Done. So strategy is quite simple. If I have to check today's stocks, how many stocks gave entries, how many were in profits, how many were in loss, I'll just show you in the explore section. I'll go to analysis. Well, today 14th of September, right, and I'll just click on explore. So today you will see that there are 4 trades or 5 trades: Kolpal, MGL, Ujjivan, UPL and Voltas. So here I have profits as well. In the parameters, I'll show you what are the parameters. Target I have kept as 1%. That means I want strict 1% target. Stop loss is either 1% or first candle's high or low, whichever is lower. So the adjustment is automated. The maximum stop loss that I want is 1. So the target is 1, stop loss is 1. So risk reward is 1:1. But if first candle's high or low is broken before 1%, then we will exit then and there. So my stop loss essentially reduces below 1%, making my risk reward much better. So in today's trade, you will see that Kolpal had a short at 1413 and exit at 1417. So gave me a small loss of 3 rupees. And MGL gave me proper 1%. Buy at 920, short at 929, gave proper 1%. Then Ujjivan gave me 1% again. You buy at 230, you short at you square off at 232, and UPL gave me a loss of around 1%. I sold at 503, bought at 507, so there's a loss. And Voltas, as I've shown you, gave proper 1%. So what you'll see that out of 5 trades, 3 trades gave me 1% each. 2 trade gave me a loss of close to 1% each. So net to net I've made 1% profit, right? Similarly, if I check on any other day, say on last Friday 11th, and explore, so on 11th there was no trade. As I said, there are some days when there are no trades also. On 10th, let me just check. Yeah, so on 10th we had few trades. So you'll see there were 5 trades again. 4 were in profit, 1 2 3 4, and only 1 you can see in the minus. right? One was in loss. Now the one which was in loss, you're having a loss of only 2.95, whereas the stock price is 493. So you can clearly see that my stop loss is well below 1%. If there are profits, it is fixed 1%. If there are losses, then it is either 1% or less than 1%. In this case, my stop loss was never triggered, but in case it triggers also, it will be very, very small or maximum 1%. So my risk reward is automatically adjusted. Now if I backtest this strategy for last 1 month, say today is 14th, so from previous 14th August, if I backtest, what I would find is that the accuracy of the strategy is 58% and losing is 41% only. So almost 60% of the times I'm winning. And if I see backtest report individually, let us say when there is a loss, so loss is 0.5% or worst case 1%, but the profit is fixed 1%. You can see whatever is in green is either 1 or 0.99. It is all fixed 1%, but the stop loss varies from 0.5 to 1%, right? In some case it is even 0.28%, a very small stop loss, 0.67, 0.32, very small stop loss, or worst case 1% loss. So what I'm trying to explain here is that this works very well. You have to be consistent. There are days when there are only 1 or 2 trades and both of them are in loss, but the loss is very, very small. And there are days when there is 4 to 5 trades and all of them are in profit and all of them are giving you 1%. But on an average, it tends to give you 1 to 1.5% returns on an average every day, right? So in a month, if there are 20 to 21 working days, after cutting down your brokerage, taxes and everything, you're able to make more than 10 to 12% returns on your investment without using any leverage. But if you're using leverage, or if you're trading bracket order, if you're using 10x leverage, then your 10 or 12% returns would literally become 120 or 130% returns in a single month. That means you're actually almost doubling up your money every single month using this strategy. So I have also backtested on my separate server for the last 6 months data, and these were the results. Winning trades 61%, losing trade 39%, CAR 210% without any leverage. With leverage, you can imagine what the CAR would be. And if I have to show you the reports, so in the analysis, if you see the reports and if you see the charts of your portfolio, you will see that your portfolio is slowly going up very steadily. It is not coming drastically down, it is going slowly up. So a very healthy portfolio as well. Now beginners might have not understood a lot of things in this. I would strongly recommend again to them to check out our free series on entire stock markets. Now in the next lesson, we are going to take a step ahead. I'm going to discuss the entire parameters of this AFL on my AMI broker. I'm going to automate in the live market. I'm going to record the performance of this strategy in the live market for an entire week, Monday to Friday. I'm going to run it on my personal account. Let's see if it is actually giving profits or not. And I'll share the live reports, as said, 1 week live performance reports. Also I'll share the entire thing will be recorded. And also at the end of the video, I'm going to give you a small surprise that if you want to follow this strategy without coding or without algorithms or without even buying data, I'm going to show you a small surprise in the next video where I'm going to help you follow this strategy, if you like, without any coding, without any AMI broker, without any data. Stay tuned. I'll see you in the next video. Thank you so much. Spread knowledge because it's free. And if you have liked this video, do like, show us your love, and do subscribe to our channel if you have not already done, and share these strategies and our educational videos among your friends. And I'll see you in the next